Welcome to the Atomic Level, the show where we decode the matters of wealth one insightful conversation at a time with the rising stars in finance, business, and tech so that you can grow and protect not only your net worth, but most importantly, your net happiness. I'm Chris Snook, and today I am thrilled. We were just having so much fun in the green room talking about Vail. I am welcoming Barry Knapp to the show. He is a macro legend for those who have been in the markets at all for the last 40 years. You know the name, you know the face, you know the voice, you may know the frameworks, but today we're going to go deep on the atomic level and find out where he is today, what shaped that worldview. Barry, welcome to the show.
Thank you.
All right. So as we let the live room fill up here, those listening to this on replay, welcome. As we let the live through, feel free to share it, restack it, do the things, right? Hit the heart, hit the like, hit the algo, do all that stuff so the dopamine gives the algo what it wants. But let's start and warm up, Barry, just for those who may not know you as well as they think. You know, what shaped the man and his worldview as it relates to markets, business, and everything in between? Just give us kind of the backstory so we know a little bit more about, well, when we're listening to the frameworks, what helped shape those.
Sure. Hopefully I won't go too far afield here, but I'm the son of a professor of electrical engineering at the University of Connecticut. So I grew up in a town where 80% of the kids in my high school were university kids. I think I always had a healthy degree of skepticism, cynicism about ideas that were being, put forward. But I went to college thinking I was going to play pro soccer, not be an economist or macro strategist. I got letters from Ivy League coaches, but University of Rhode Island was ranked 6th in the country. They beat University of Connecticut. That's where I was going because that's what I thought I was going to do. Thank God it didn't happen. I just starved. The NASL collapsed my senior season. And so no draft, none of that stuff. But my high school guidance counselor suggested I study economics, and macro 101 freshman year, man, the lights just went off. And I just fell in love with it, reading the Wall Street Journal every day. And that was an incredibly interesting time. Of course, Volcker was raising policy rates to 20%. Every week in Newsweek magazine, Milton Friedman was debating Paul Samuelson, Larry Summers' uncle, the dean of New Keynesian economic thought. And Friedman was the revival of classic economic liberalism, right? And so I was Uncle Milty all the way and just kind of went down that path. In fact, the last required economic class I had to take was that I kind of love this story. Hopefully everyone won't think it's too economically geeky, but it was the history of economic thought. The professor had gotten his PhD at Berkeley and had been self-described former Marxist, now Thorstein Veblenite, the theory of the leisure class, the idea that half of the goods produced lead to the betterment of mankind, the other half don't, and the government should regulate those. So I wrote my final paper pro the scientific method, referred to Friedman as Uncle Milty, and called Veblen a normative stick in the mud. My mom, after my dad passed away, stumbled across that paper and sent it to me. And I got one of 3 A's out of 60 people. That was in the age of intellectual honesty, where he made a good argument. The professor was okay with it, even if he didn't agree. Right.
Yeah.
Anyway, that sort of started and shaped my ideas. I went to New York. I didn't know a soul. I didn't have any connections. I ended up getting a job as a wealth advisor, financial advisor at Merrill Lynch in the Fifth Avenue financial complex. I looked around an office of 80 brokers and said, who do I want to be like when I grow up? And I said, none of those people. And got an MBA at night. Finished it in 1989, was taking classes during the crash of 87. We were all regaling stories of what happened that day. I was running a small trading desk for Fidelity Investments in their first New York branch at the time, and got a job at Lehman Brothers on the derivative desk. And from there, I was institutional equity derivatives for 15 years, was responsible for macro hedge funds and big quantitative managers. Sometimes I feel guilty about the stuff Mike Green's written about indexation distorting the markets, because I was sort of an early player in that business and ran that business for Lehman. Made managing director in 2000, then started trading Lehman's money in the 2000s and kept getting asked to move into research. Became the equity strategist in 2008, right before we went under. Did that job at Lehman Brothers for Barclays, actually, for 6 years. Was Rick Reeder at BlackRock's effective director of research for a couple of years. Back to Guggenheim, to Guggenheim Securities with some ex-Lehman colleagues to develop a macro product. Guggenheim wasn't really going anywhere in capital markets. And then I started Ironsides in 2019. So I've been in, derivatives, trading, portfolio management, and then research for the last, I guess, almost 20 years now in research. And just always loved, the macro stuff. That's why I covered the macro hedge funds and big quant managers. And my views on markets haven't really changed all that much from those days back in college, in as much as I've always been inclined to think that markets are better allocators of resources than elite technocrats, the way Joseph Schumpeter would have described it. I've been a classic economic liberal from the very early days, and that's still how I think about markets today. And I was going back and looking at my 2026 outlook note because we're at mid-year, and I was going to discuss it a little bit in my weekly, frame out how things have developed so far this year. And the main theme for this year is the Fed shrinking their footprint, privatizing their balance sheet, stepping back from what I've been describing as socialism with central bank characteristics, kind of a play on the whole, socialism with Chinese characteristics. Kevin Warsh was, although Rick Reeder's a friend of mine and a great guy, Warsh was the guy with the most credibility in terms of shrinking the Fed's footprint. And so he's the guy Scott Bessent wanted in the job. And I think he's the right guy to do the job. And the Fed does need to shrink their footprint, and we need to let the markets allocate capital. So,
all right. So that's a good.
That background tells you a little bit about how I
so it's great. So I got a question. As we talk about the soccer stuff real quick. So, how are we going to do this year? Is the U.S. going to make it into a significant round? They looked good against Bosnia the other night.
They did. It was a diabolical red card. Under no circumstance should that have ever been a red card. And Flo Balogun is a tremendous striker, the best center forward we've ever had. This is far and away, and this is that was actually the worst call since Clint Dempsey had a goal taken back in 2006 in Kaiserslautern against Italy. And me and my buddies were right on the line and saw that he was onside. There was no VAR in those days. But this is far and away the most technically gifted team we've ever had. I mean, their speed of thought, speed of play is just at a level we've never had, and is comparable to almost any other team out there. I mean, clearly France's attackers, different level. The Portuguese midfield, maybe different level. But this is a really good team. Little weak in the goal. Some questions in defense, although it's getting better and better. It's going to be a shame not to have Balogun. We're way faster than the Belgians. Way faster.
Yeah, it's fun to watch.
We should be able to beat them even without Balogun. There were questions about, this team's determination relative to, say, the 2002 team or 2010 team, Dempsey, Donovan, those guys. I think they've overcome that. They overcame it last night. They are
the thing that impressed me. The thing that impressed me the most on that, and I was kind of watching it with one eye and whatever, doing some other things, but
I was 5 feet.
I don't remember too many times where we've made a penalty kick outside the box and made it look like something that Messi or someone would do in their sleep. But like those kind of little things, like where we're putting those kind of plays into the net. I got excited the other night. I was like, oh, maybe I'll get to root for our team. This is great. So anyway, all right. So back to the macro stuff. So because we could talk about soccer and skiing, I'm sure, for quite a while.
Yeah.
So, all right. So, talk a little about Ironsides. Give us, kind of the high level, just so that people that don't know what you do there.
Sure.
What is Ironsides? It's institutional clients, I'm assuming primarily or exclusively, but just talk to us a little bit about kind of what the offering is there, and then if it's modified at all since 19, post COVID or not, and kind of what the vision is.
Um, yeah, well, my client base when I was Barclays equity strategist, when I was at Guggenheim, was an institutional client base. There were some Barclays or Lehman wealth management clients that had access to the research, but it was primarily targeted at institutional clients. And even within the institutional client base, it tended to be um, pretty dense. The way I approach markets, I was in equity derivatives for a long time. So while that was going on, though, I was a frequent guest on CNBC and a frequent guest on Bloomberg, but Fox Business. And so, I got in the mode of, trying to make complex subjects approachable. And when I started Ironsides, my idea was sure, I was still going to have those institutional clients. They didn't really care whether it was Ironsides or whether I was still at Barclays or otherwise. So I was going to write notes that helped their process. But I also wanted to make the product approachable for reasonably sophisticated individual investors, wealth advisors, RIAs, all those. And so, at the end of the notes, there is a table with sector allocations, and that's how I do things. I don't tell you I like Apple, I don't like Meta, so on and so forth. It's okay, where should you be sector by sector? And my weightings are very specific relative to the S&P benchmark, like 25% tech, not 38% tech sort of stuff. And it's laid out for you so you could easily implement the strategy using ETFs, which is what I do with my own money. I don't buy individual names. It's a macro process. So I give you a macro strategy. You could use that as an overlay and pick names, but here's where you ought to be. And that's what I did for the big institutional clients and now do it for, try and make it approachable for everyone. I made the pricing approachable for everyone. So $1,000 a year, you can read this institutional quality level research along with asset allocation. So where should you be stocks versus bonds? What portion of the bond market should you be in? Intermediate portion, front end, back end, corporates, treasuries, mortgage-backed securities. Again, all this is implementable using exchange traded funds just to simplify things, but to really give you a broad sense. And then, listen, one of the things that stuck in my mind a long time ago was when I was Barclays equity strategist, I was in seeing someone from the Capital Group. And of course, as I described earlier, my client base when I was in derivatives was big macro hedge funds, right? And they would change strategy around all the time. And they kind of cared on what was going to happen over the next couple of months, right? What trade could I ride for a few months? And I remember seeing this old line portfolio manager at the Capital Group. And he said, sort of gave me one of these, Sonny, you got to tell me about secular trends that are going to persist for 5 years, right? And so you can see that in when I do my year ahead outlook notes, I'll write and this year's outlook note is outside the paywall on the front page of my website. um, that'll be what's going to happen over the next year. How are things going to develop? But then I'll write a secular trends note for the next 5 years, 10 years. Like, how do you think about what's going to happen over the longer run for family offices and people investing generational wealth, or just someone who doesn't want to look at the market every single day? How do you think about these longer term trends? And that's a fascinating part of the job. Is like, I'm convinced we are going to have a strong CapEx cycle for a myriad of reasons. I think we're reaching a near term cyclical peak within this secular trend. So how do you think about that from a tactical and strategic perspective is how I try and create the research,
So,
make it approachable for, sophisticated individual investors. And I have friends that have sort of given up on outside advisors and are just uh, using my sector allocation as how they're running their money.
Yeah,
Not to prep.
I think it's an interesting window for that evolution. We work with a lot of advisors. I think there's a bull market um, for good advisors that is probably going to be very rewarding for the active ones. There's also kind of this, wealthy, I can get research from people like yourself or whoever my selects are. I could pop it into maybe a model that I own or that I leverage, and maybe I can run my own money or a portion of it in a different way. And I think it's an interesting time. The value of insights is no question and trusted insights is the thing that, I think Substack is becoming an interesting platform for, kind of as it gets the network effects of guys like you and me and everybody else. So let's go through your framework though, and let's apply it to that CapEx thesis, because I think that could be a good one. I think there's some controversy around that, so that's a good one to take your framework through the kind of thing. So talk to us about how whether it's a CapEx super cycle that is weighted heavily on, kind of the AI CapEx spend right now, but that you think continues even if that pairs back. Meaning, what I heard you say in there is that the secular trend of AI driving it is not going to be the thing that ends it. And so I'm curious how you take your framework, break it down for us in parts so we understand what you run it against, and then use that as the first use case. And we'll take a couple through there that I would love to ask you about. But start there. Let's walk through the framework
Sure.
once with that as the thesis.
Sure. The origins of um, well, more broadly I would refer to it as the manufacturing renaissance, right? Or US manufacturing renaissance. So going back to 2012, when I was Barclays equity strategist, I started really digging into the effects of the shale energy revolution when it was really taking off. So I went and sat down and of course, Barclays had pretty much the number one II research department. So I sat down with every analyst that had um, anything to do with energy, whether as an input um, to the products that were being sold and produced, or whether they were the actual producers. And it just started to blow me away as to how impactful this was going to be. There was a really interesting Boston Consulting Group report that was put out at that time called The Tipping Point. And the idea was the tipping point that the edge that China had in manufacturing had been largely arbitraged out for something like 2 trillion of industrial production per year in the US, meaning productivity adjusted labor costs had largely equalized because they've been rising in China so quickly since we gave them most favored nation status back in 2002, admitted them into the WTO. Transportation costs were rising rapidly, but our energy costs were relative energy costs were plunging. It was the revival of the chemicals industry, for example. And, exchange rate costs had started to go up. China no longer had a pegged currency. There's a whole myriad of reasons why US manufacturing looked more attractive. Now, we had a couple of hurdles to get over. First of all, it's expensive to invest in it. Now, there were a series of shocks back in 2011. The first was the Great East Japan earthquake and tsunami, which shut down the auto industry for 4 months. Later that year, you had floods in Thailand that shut down parts of the electronics industry, semis, for example, for several months. So we started to get these supply chain shocks. Of course, we had a whole series of them to come, right? The
Right.
first Trump trade war, COVID, the second trade war. So there started to be the risk management portion of it. You had the relative costs. We needed tax reform to make this an attractive destination for capital. We did that in 2017. We locked parts of it in with the One Big Beautiful Bill Act a year ago. So you still have China subsidizing manufacturing. It's still, there's still some barriers to this. But if you think about CapEx during the 2010s, it was the second weakest business cycle since World War II. The only weaker one was in the late 50s when Ayn Rand published Atlas Shrugged, right? And so, there's a real argument that we've been underinvesting in our capital stock for decades, right? If you look at structures investment, which is physical plant as a percent of GDP, it was 3 to 4% from World War II all the way through the 90s, and then has been 2 to 3% ever since. So, there's a real case to be made that we're going to have a structural build out that transcends the entire AI story. And so that piece of it is just starting to gain momentum. My sector allocations
Do you
reflect
see?
that.
Do you see that? Keep your thought going, but just as you say that, I want to. Do you see that as the off ramp to the AI CapEx story breaking down because of the accounting gimmicks at some point? Like, in other words, do you see that as the natural off ramp of, oh, guess what? We still haven't fixed all the highways, all the bridges, all the right. Like, we'll do that now because that's a big place to go bury another big amount of fiscal spend and just make smooth out any potential
Well,
correction.
not fiscal spend, but private sector spend, and here's another big element to that broader capex boom thesis. So we've had two big capex boom decades since World War II, the '60s and the '90s. The common threads between those two boom cycles: one, we had favorable supply side tax policy, so not widely recognized, but the first thing that JFK did when he was elected was he changed depreciation schedules. And
Mhm.
then they had corporate tax reform that was passed by LBJ, his first tax policy after JFK was assassinated, that really accelerated the capex cycle in the '60s because it was picking up steam before when JFK was first elected, but then it really took off after that. By the way, it had nothing to do with the inflation of the '60s. Um, the other things that occurred is we had price stability. Now, I define price stability as the standard deviation of all items CPI. It averaged about 35 basis points or so through the '60s. Didn't really matter what trend inflation was. It's just that prices were fairly stable, right? The same thing was true in the '90s. The trend rate of inflation was higher in the '90s, but
Mhm.
that standard deviation, prices were generally stable. Central bank had something to do with that. Um, so did fiscal policy until later in the '60s. You also had bank regulatory reform, significant loosening of bank regulatory policy in the '60s and in the '90s.
Well, yeah, because
And
Glass-Steagall and that kind of thing in the '90s. What was the
well,
si
you started to just get that credit impulse into the market where the banking system, rather than just holding treasuries like they did during World War II and the aftermath of that, and I could talk about that whole thing for hours, um, they started to really increase lending into the private sector in the '60s. The '90s were the same thing. After the savings and loan crisis,
Mhm.
Greenspan loosened the regulatory reins, if you will. And of course, he's sort of an Ayn Rand disciple, so it makes sense he would have been doing that. Warsh is headed down the same path today. So you had pro tax policy, you had regulatory policy that created the credit for the capex boom, and you had stable prices. And in each, the '60s, the '90s, and now the '20s, that's going to build. We
What
had
is
a
that
little bit of a
delta
setback.
today? You mentioned it was around 35 bips in the '60s and '90s as far as the price stability across all CPI. Where is it at today? Is it at 50? Is it at
Uh,
38?
well, so just for some perspective on that, the post World War II median is 58 basis points.
Okay.
Um, the median CPI rate is 3%. So right now, we are standard deviations in the 40s, but likely to go, it'll be volatile because we're about to have negative prints in CPI, but then
Mhm.
it'll probably return. It was 24 at the beginning of the year. So we'll probably go back down into the 30s or so. And so that's why I maintain, I really, first of all, the 2% target, people need to understand that that was intended to combat deflation, not inflation. It was enacted in January of 2012 after 2 years with a median core PCED, the Fed's preferred measure, was 1.57%. Bernanke enacted it to show the Fed's determination not to let deflation happen here, which was Bernanke's obsession because of his study of the Great Depression. Um, we've only had one business cycle since the early 60s where inflation was below 2%. It's a ridiculous, unachievable target. We should just be thinking about it in terms of that standard deviation, a range. Warsh says, I really only concerned with the left side of the decimal point, meaning if it has a 2 on it, that's good enough. Let's just try and keep prices fairly stable, not overly target inflation to a precise 2% number, because what that did in the 2000s was that actually weakened the CapEx cycle because the Fed kept rates far below where they would otherwise. So money went into, as Warsh said yesterday to Sarah Eisen from CNBC, it went into financial engineering. It went into
Right.
buybacks. It went into private credit. It didn't go into productive, hard investment uses, right? And so, anyway, I think the backdrop is there for an extended CapEx cycle. But if you want to talk about the AI thing or the AI portion of this, the leading edge of it, a super important topic too,
Well, I
because
think I think
I've
we should
actually
lead in with
been.
that. Yeah, I want to lead into that as it relates to how you apply your frameworks to understanding where we are in that CapEx spend cycle, because there's a lot of things being thrown around. I have my opinions. Everybody has their opinion. There's data. Okay, great. What does Barry's framework say about where we are in the AI CapEx schedule? Because some would argue, I might be on that camp, but again, I might also know enough to be dangerous on it. Some would argue that we're basically pulling profits that don't exist from contracts that could be revoked into the present day using depreciation schedules that are pretty much guaranteeing the thing that is being purchased will be obsolete before it's even plugged in with energy we haven't created yet. And we are 100% all in on that bet with CapEx. So something has to change. That's what somebody might say.
Right.
But but again, that doesn't mean it's a complete picture. What is it that you see there? And then where do you feel like we are in that arc of flattening out, dropping, whatever? And then where are we at in this other infrastructure, CapEx spend, private investment? Because the incentives are there. Seems like now the monetary policy will match the tax policy and the fiscal policy spend. So it seems like the pieces are in place. You've analogized it to the 60s and the 90s potentially. Seems like the price stability is in that same range. So it seems like all the ingredients to have something smooth that out are there as well. But I want you to put it all together for us, because I'm
Sure.
just
Well,
leading with what you just said.
you've brought me back on track a little bit, because part of my reason for bringing up the 60s and 90s was when the tech bubble burst in the late 90s. We had a decade long CapEx cycle where non-residential fixed investment from the GDP accounts or national accounts had increased at almost a 10% annualized rate for a decade. Um, and the 70s, 80s had been pretty strong as well. So arguably we had a broader, longer CapEx boom. And so the pieces were in place for a bust. And I remember actually on the golf course talking to Bill Dudley, the former president of New York Fed, about this, him describing when he was Goldman's economist, how he kind of came to that conclusion in the late 90s. And um, I guess it didn't sit too well with Abby Joseph Cohen. And anyway, but those conditions are not in place today, right? We don't have an overextended CapEx cycle in everything else. If you looked at CapEx as a percent of cash flow, and I'm going to come back to this metric because it's really important for the industrial sector, it's low, right? The industrial sector has not overinvested in its capital stock for decades. So, being someone who focuses so much on markets, having been an equity strategist, but having spent a lot of time in fixed income as well, knowing a ton about credit markets, I have a couple of metrics in place. I mean, obviously, as sort of an equity strategist, equity person at some level, you want to think about the whole monetization argument. And my view was when we got to these IPOs this summer, we've had one, maybe Anthropic. OpenAI seems to be pushing it back, probably for the reasons I'm about to describe. There's lots of questions about monetization and return on invested capital. Those are a little tougher to quantify, but those questions are undoubtedly there. And this is a point in time where they're getting seriously questioned. My report last week was titled Demand Destruction, with the idea that, hey, if you're a DRAM manufacturer in a formerly cyclical business and you raise prices fivefold, you might think, yeah, I locked in contracts for 3 years, but you're going to destroy demand at some point. So there's that issue. But then I have two other broad frameworks in mind. One is that CapEx to cash flow metric. We got to 80% in the telecom sector in 2000, and those were slow growing businesses, and that was about it. Right. And so
Yeah,
then you
that's
started,
what I want. I'm glad you go on that because I was like, I wanted to analogize it to the global crossing to that and get your understanding, but I didn't know that number. So we were at
100%. Now,
80% then. We were at 80% to cash
80%
flow then.
CapEx to EBITDA, right, to cash flow.
Yeah, yeah,
So
right.
that's my big benchmark. It's also relevant because in 2015, the energy sector hit 80% of CapEx to cash flow, and the price
Interesting.
of oil plunged 77%, right? So the underlying businesses are different. They're more dynamic. They're growing better. The companies spending the money are in a little bit more resilient position than were baby bells back in 2000, or energy companies in a notoriously cyclical business. But nonetheless, that's a really important benchmark. We're at 65% right now for the big five spenders, right? And we know who those big five spenders are: Amazon, um, Google, Microsoft, who's actually the lowest, Meta, and Oracle. Oracle's far and away the biggest spender as a percent of cash flow. Meta is the one most likely to crack first, I would argue. Um, and yesterday's story that they're thinking about renting out some of their storage business, to me, is another sign that, hey, this may not be sustainable. So you're likely to see the rate of change of CapEx start to slow here,
So I want to
which is
clarify. I want to clarify that metric. I think I understand it, but I want to clarify in case I'm off, or in case anyone in the audience wasn't sure. So when you say 80% to cash flow, you were talking about when you looked at the top big spenders.
their CapEx spend, their CapEx expense
So per
as a
unit, so
percent.
like if we take the Max 7, if we take the Max 7 for instance, just for round numbers, if we took the Max 7 right now on a company by company basis, they're averaging somewhere around 65% of their CapEx to cash flow spend. So Meta might be a little higher, Oracle might be a
I
little
want
higher.
to be clear, not the Mag 7, the
Okay.
big five spenders on data centers.
Okay,
Right.
the big 5 on data centers, very specific.
Right.
Okay,
So
so
Google, Amazon, Meta, Microsoft, and Oracle. Those are the
where does
biggest spenders
okay,
on
gotcha.
data, building
They're
data
all right
centers,
around.
building compute, right?
So if we were to use
Now,
history,
let me just add one little thing there. The communication sector, which is the grandchild of the telecom sector. Things have changed a lot because they S&P rebalanced the indices and all. Expected CapEx as a percent of cash flow is about 65 right now, even for that sector. So that's a pretty good benchmark. We're not at 80, but if we stayed at the current rate of change, we could be there in a year. I don't. I think the rate of change is going to slow, is my point, but nonetheless, we're not at 80, but we're moving up quickly.
so I wrote a piece about a year ago or somewhere around there, deep on the Blue Owl kind of meta deal down in Louisiana, right? And just all the potential legal but Enron-esque level things in there, right? And not saying it was that, but just basically saying, you have this asset that's being committed to for 20 years. You have private debt and everybody forming into it in these SPVs. And ultimately, at the end of the day, there's one tenant for this thing, Meta. And if they decide they don't want it, they have all the out clauses you could imagine in that lease to basically not continue. And then who fills that void, right? Is it just a big box to nowhere type of thing?
Yep.
Again, I say that in the sense of, you mentioned Meta, but if you just broaden that out to, we're still below the quote threshold that historically has said something changes, right? Um, we could get there within a year at the current vector if things don't, soften. Where does that ripple out? And what moves do you see, or what tea leaves are you reading that tell you which way we're heading? Are we going to keep running right to that cliff and just test it because this time it's different, quote unquote? Or are we smart enough to realize, hey, we're going to pair it out? And so where do you feel like we are from your lens?
Well, so the next important metric or market I'd be looking at to gauge this, and I've written a lot about this, is the credit markets. And so my original thesis, if you look at what happened in 2000, the run up to 2000, you look at what happened in the energy sector in 14, 15, you'd see it in credit spread widening and credit markets. Now, we haven't seen any credit spread widening, really, and we've had record level of IG credit issuance. That was part of my thesis for this year, was you were going to get a push higher in nominal treasury yields, but more driven by real treasury yields. So the 10-year tip rate going to 2.25, a level that in recent years has caused risk off, you know, 8 to 10% equity market corrections because financial conditions are tightening. But that would be driven in part by the demand for financing to build this whole thing out. I thought you'd start to see cracks in credit spreads. Instead, what you're seeing, which makes perfect sense, is the redemptions in private credit funds. For example, this morning we had Blue Owl redemptions, and I heard Leslie Picker talking about it on CNBC and saying their tech fund redemptions were either 35 or 38%, far bigger than their overall redemptions, right? So remember when these redemptions started picking up in private credit funds, at first it was about software, being
Right.
disintermediated. But then all of a sudden, the Powell's getting big redemption requests, and they've been the most vocal about getting out of software. So they're like, I don't think this is just about software. This is about again, think back to my bank situation and the fact that bank regulatory policy has been so tight that the banking sector, like the loan to deposit ratio in the big banks has never been lower.
Hmm.
Banks are effectively government bond funds, right? So
Right.
they're not in the private sector lending business. They pushed all this out to private credit funds. I could tell you an anecdote story about that one too, but
I
um,
love anecdotes. The audience loves anecdotes, so feel free.
okay. So in 2011, 2010, right after Dodd-Frank was passed, I wrote in a Barclays equity strategy report that Dodd-Frank was going to cause an explosion of non-bank lending. They were just pushing all the risk outside the banking system. Um, the New York Fed called me at about 8:15 on Monday morning, and I had a conference call with them about an hour later. They're like, "Are you kidding me? This is not what was supposed to happen." And well, this is what's going to happen. You didn't eliminate the risk. You just pushed it outside the system that you regulate, right? So
Mhm.
a ton of money got pushed into private credit because of, regulatory arbitrage. And so now as this demand for financing these data centers continues to accelerate, um, the money needs to come from somewhere. So if you are an investor, you get your money out of a private credit fund, you can then buy these deals. But if spreads start to widen, things start to go bad, you've got the liquidity, boom, you're out, right? And so there's the sign for me that we're reaching the saturation point, is all these redemptions from private credit funds, particularly, Blue Owl's tech fund, which is sort of the poster child for all this. And then of course you can look at the big four spenders, hyperscaler stock prices, the fact that Micron's trading at a 7 PE. The way I learned cyclical investing was you bought a cyclical when the PE was the sideways 8, infinity, because they're losing money, and you sold it when it was 4, right? And when PE start contracting more and more, it sort of tells you you're reaching that saturation point. So um, we'll see if it happens with second quarter numbers. They smartly are not all reporting on the same day, at least the big four of them, like they did last quarter on a Fed day, which was absolutely insane.
They
But,
learned their
you
lesson.
know, I do think this rate of change is going to slow. And the benefits of all this investment are going to start to accrue to the consumers of the tech from the producers of the tech. And, as a consequence of all that, and I still bench myself to the S&P because I have lots of institutional investors. I'm trying to take lots of risk around that benchmark because I recognize a lot of my readers, my subscribers, my clients are not just, closet indexers. Um, but I'm at 25% tech, 5% comm services against benchmarks of 38% and 10%. So those two sectors should be that's 48% of the S&P and I'm at 30. That's a pretty big relative underweight or bet. And my idea is that this trade is running into this whole investment boom is running into a point in time that if it doesn't slow, you know, it'll hasten the end of it. But it probably will slow. And that means the rate of change of earnings growth will roll over. And that rate of change of earnings growth is a huge driver for stock prices. Like right now, earnings growth is accelerating, but to levels that are not sustainable. So that should make any investor somewhat apprehensive. It doesn't mean we're about to hit, as I said before, because we've underinvested in CapEx, we're not at the end of a business cycle. We also don't have a Fed that's about to make a policy mistake. The Powell Fed probably would have. The Warsh Fed won't. They're not going to raise the policy rate. We should talk about that unbalanced policy at some point too. But so we're not at the end of the cycle. But if the AI piece of it doesn't slow, that could be a systemic risk to the
Yeah.
broader economy, the broader markets.
Man, there's a lot of follow-on questions to that. So I want you to kind of go in and around and weave and go a little deeper and sideways, because I think there's a lot of ground that you just covered that's interesting to unpack. So, let's start with where where do you think, or do you know, because of watching the flows, these redemptions, when they're honored, because there's that to the gating is already started. We saw that happen several months ago, pretty rigorous gating. Now we had some big redemption requests yesterday. 35 to 38% is a huge amount of capital flight right out of a position. Where do you think it's going? Is it going into cash and just sitting? Is it going into, like, where do you see those flows going, or where should they go if they're moving out of, let's say, private credit and back into some other kind of dry powder strategy?
Well, they'll go into pardon me. They'll go into the public deals, right? So, um, you know, public deal. If you buy, whenever Meta's bond deal or SpaceX's bond deal, and things start to go south, you sell it, right? And I have one of my good friends is a sort of a good example of this. He's a wealth advisor with a very large book. You know, he'll call me up last quarter after the banks reported, and he said, "Hey, Goldman's trading 50 basis points through Wells Fargo." And I told him that's absolute nonsense. The only reason that's the case is because Wells Fargo had an asset cap, so their book looks cleaner. They look like less risk to private credit and the like. No way. Goldman's about to get regulatory loosening. Buy Goldman. When's the call on that? He said 1 year. I said they'll be calling it in a year because they won't need this credit buffer anymore. So that's the kind of stuff that people will buy. So it's sort of a return to public markets from private markets. The attractiveness of private markets was when the Fed, and they still are doing this, right? I mean, $6.5 trillion of long duration securities with a weighted average maturity of nearly 9 years, when Treasury outstanding is more like 5.4 years. The term premium you receive for taking maturity risk is about 70 basis points, roughly 50 to 70 basis points below the longer term historical mean. The Fed's suppressing those rates, right? So that's why Warsh wants to clean up the balance sheet. But that drove money into other stuff like private credit, and private credit looked attractive. Well, now they've got issues for sure. I remember, them running commercials. Hey, we can give you double digit unlevered returns. And all I could think was, who the hell is paying that financing rate, right? Like, what kind of business do they have that they can pay you SOFR plus 500 when SOFR was 5.5%? Like, that's insane, right? And sure enough, there's gonna be a credit cycle. There's gonna be credit losses within that. So you
So
can get
that
out. If you can
leads me.
get out. And, listen, there's lots of good issuers. We know who the best ones are. I'm not making a general statement about it. It is an interesting business. And the direct lending business is fine, just like CLOs are fine. All that business is fine. And we're not about to head for a recession. So we're not going to have a big credit cycle. And in fact, the broader metrics, non-financial corporate sector debt relative to GDP has been falling this cycle, not going up, right? It's at about 42%. All the historic studies, Reinhardt and Rogoff, guys like Steve Ciccatti, who've done studies on this, 90% is the level where it's systemic. We're at 42. So we're not about to have this big, broad credit crash, but, like, why not take it out and buy the public deals? And then things don't go your way, sell the bonds, buy something else, buy treasuries, whatever.
So I'm glad I asked the questions in the order I did, because that was the clarity. It makes sense. Number one, because you're rotating back now into the regulated environment with, like, you're just moving back to where it's safer, and you can always sell if things change, right? So
More transparent,
more transparent.
market.
So the question I have there, and this is anecdotal. So again, this may be, you could just say, nah, it's not an issue, and we can move on to something more meaningful. But you have a very interesting vantage point because of riding through the Lehman side of things, right? And so, I was at Milken last May, not this one, but the one last year, right? So whatever that was, 14 months ago. And I was standing in the lobby at some point. Some guy came up to me. We chatted up. He was in his 30s, young guy, sharp, whatever. I can't remember who he worked for. What he did was he did kind of CDOs and CDS swaps for basically private credit. And his minimum, his minimum order was 9 figures. I mean, it wasn't like you weren't getting into his client book unless you were allocating $1 billion plus into some kind of position, right? I just remember feeling like not good, like, because he was sharp. There was nothing wrong with him. I just remember hearing it and kind of going, how big is this derivative rabbit hole on private credit, right? And are we repeating this again? Now that's just the feeling I had. I don't have any data to support that. I had one conversation, so I want to be very clear. Nothing about that other than just, it didn't make me feel good.
Right.
Where do you think that risk lies or isn't right now as capital redeems and rolls back into stuff? Is there potentially some black hole of, swap markets and things like that on these private credit funds that could be uglier than we think, or is that not a concern?
Um, I I think that the structures, covenant light issuance, a ton of money flowing into private credit, collateralized loan obligations, they rhyme with the stuff that was going on in the early 2000s. But first of all, the broad metrics of debt, so debt to total household net worth for the public sector, household sector, non-financial corporate sector, and the corporate sector show that all of the excess debt, the only sector that is above that 90% threshold level is the government, right? So household debt has been falling as a percent of GDP since the financial crisis and still continues to contract. It's nowhere near the levels that you can get spillover effects into people's broader spending, a housing crash that affects wealth. Wealth effects are a little bit different issue, but you just don't have that level of debt at the household sector. As I mentioned earlier, bank loan to deposit ratios, the exposure of the banking sector, which is far more levered than these private credit funds, which have very little leverage. They have 1.5 turns in their public BDCs. That's not the 30 turns of leverage we had at Lehman Brothers. And then, of course, I mentioned the non-financial corporate sector, debt to GDP has been coming down, and that's not a source of systemic risk either. So having this whole thing evolve into a bigger, broader event that looked anything like the global financial crisis is unlikely as well. Now, policy is what really lights this stuff on fire, and so I think this might be a useful way for um, the listeners to understand what really happened in the 2000s. So in 2002, when we had the first refi boom and Bernanke gave his speech, deflation, it could happen here, the so-called helicopter speech. Um, Fannie Mae made a fantastic bet, one of the biggest bets they've ever made, anyone's ever made, and refused to hedge all of the prepayments that were coming in and wound up with this giant short in the treasury market. And the market sniffed it out, ran them out of the position. There were congressional hearings, a new regulator. It used to be OFAO and now it's FHFA. And Fannie and Freddie were unable to take any duration risk, any interest rate risk for the rest of the cycle. Instead, they decided to take credit risk. So, of every CDO deal, subprime deal that took place from 2004 through 2008, Fannie and Freddie bought the super senior piece that didn't lose money unless you had 20 to 25% losses in houses, but they bought them at LIBOR plus 10 to LIBOR plus 30. You're like, who would want that, right? Such thin margins, but they had 60 turns of leverage and they had the Community Reinvestment Act requirements to meet. It's like the men who spurred us on ended up sitting in judgment of all wrong, right? Chris Dodd and Barney Franks called them up every week. Hey, are you meeting your Community Reinvestment Act requirements? It's supposed to be lending into lower income parts of the country. They weren't doing that. They were just buying these deals, right? At the non-economic piece, the deals couldn't have happened without them buying it. But they kept buying these deals, buying them, facilitated the whole run up. And then, of course, the crash happened. And if you remember in 2011, the government sued the banks for the 550 billion mark-to-market losses they had because of these bonds that Fannie and Freddie owned, which they ended up losing zero on because they never really had that big of losses. So, like, there was a huge role in the government in creating this whole boom. The only thing
Well, because it
similar,
sounds like it sounds like, again, if I get this wrong in plain speak, but just summarizing, it sounds like what Fannie and Freddie were doing was they were doing a free market position against their own credit risk by taking a short position. That short position got squeezed by basically the regulator. Like, they got squeezed out of that short position. So then they were forced into taking a credit risk position because it was the only other position left. And
right?
then they were given, as part of that, they were giving the incentive of a 60 times leverage turn instead of maybe a 10, 20, 30.
That's right.
So although the spreads were much smaller, 10 to 30 basis points above basically prime LIBOR, right? It was like, well, why would you do that? Well, because multiply 10 bips by 60 and you get an interesting number. Right now, there's a 6% spread. And so whether they wanted to, whether they liked to or not, to your point, they were forced to. And then they had this kind of veneer of Community Reinvestment Act where it looked like they were complying with it, but the caveat was there was no forced mechanism that said you can't buy 60 turns leverage on this. You must take at least a portion of your money and put it into affordable housing, whatever the thing was supposed to do. And so
Right.
they just became a financial engineering house. And then when it all was said and done, right, they sued the banks.
So the way to sort of summarize this and shorten the whole story up is to say policy created the incentive for the malinvestment, right? The
Right.
money to flow in.
And it always does. In my opinion, policy always creates.
100%. I've got the outline for a book that I'll write someday, and the title is "Mostly They Made It Worse." Right. Um, so the policy created it, but the real spark was the leverage. So this go around, we've got the Fed that has had this growing portfolio of long duration securities They held rates way below where they should have been otherwise, the term premium below. Money flowed into areas like private credit that probably shouldn't have gone in that quickly. But there's not as much leverage associated with it, not even close to the kind of leverage associated with it. And we don't have the debt in the private sector. We have it in the public sector, in the government, but we don't have it in the private sector. So there's no real, potential for a financial crisis as a consequence of this. Um, but there is a potential where you could have subpar returns on those kind of investments for a decade or more. Some of the undoubtedly the best private credit issuers will do well and you'll earn out what they expected to earn out. But it's going to be a sort of a slow burn as opposed to a crash is
Do
my
you
way of
do
thinking about
you
it because
do any of
it's
these
just not the
signals
aggregate leverage and debt in the system.
do any of these signals or any pieces of your framework deal with the non-financial risks that have to do with that wealth gap and some of these natural incentives that essentially widening it, right? Because we could argue about 2%, 3% inflation. We could pick our number. We could talk about the ranges of standard deviation being within the norms of good times of infrastructure reinvestment, 60s, 90s. We can do all that. We can make sense of all of it. And then we can look at our neighbor and realize people are more anxious than ever. People are stressed. People are underwater. So we can say that consumer debt, as a percentage of GDP is actually going down. But then we can look at the fact that, even in our own life, most people, and I'm saying this because 99% of the population, 97% of the population probably doesn't feel wealthier today than they did a couple years ago. Those are typically the reasons, right? It's the economy stupid from the 80s, right? Those are typically the reasons that people get put in positions of policy. We saw what happened in New York. We saw what's happening in other places, like with these movements around socialism and communism and whatever, right? And democratic socialism, whatever. And so, do you have a sense of the risk factors there as it relates to the broader macro thesis?
Anybody who's seen me on Kelly Evans' show on CNBC is probably waiting for me to start talking about the Fed and their unbalanced policy and the K-shaped economy. I first started really harping on this in, I guess it would have been December of 21 in an interview with Becky Quick. I mean, I've been harping on it since 2011 in my work, but for those people that see me publicly, in 2011, when it became clear the Fed needed to start tightening, I was telling Becky and just like pounding the table that they needed, because they'd eased primarily using their balance sheet, they needed to tighten the same way. That if they
Mhm.
didn't, they were going to create massive distortions in the economy. And sure enough, Powell, I've heard him described by people like Mike Green as intellectually incurious, uh, decided for
Mike's
simplicity's
Mike's
sake,
coming on at the end of the month. July 21st, we have Mike coming on, so I'll have to mention that to him.
right? Mike's a fascinating guy, and he took me to task a couple of weeks ago, and on some stuff I've written about Warsh, and so I respect his opinion. His conclusion was a little dark, but maybe not wrong. Um, but here's the point. So when the Fed started the easing process around the pandemic, what I call a pandemic policy panic, um, the policy rate was 1.5%. They cut it to zero. They bought the equivalent of 250 basis points of rate cuts in terms of the amount of bonds they bought. And that's based on some studies that were done by the former head of research at the New York Fed, Brian Sack, back in 2012 or something, that something like 560 billion of treasury and mortgage purchases was worth a quarter of a point in terms of rate policy. It's on, it's cuffing it. But anyway, the amount of bonds they bought was way bigger than the amount that they cut the policy rate. So they eased primarily using their balance sheet. We know that they took the median 5-year yield in 2020 to 50 basis points. In 2021, it was 80 basis points. They bought $1 trillion worth of treasuries in 2021. They bought 500 billion of mortgage-backed securities. The banks bought the same amount because when they bought those bonds, they deposited reserves in the banks. Banks had nothing to do with that because there was no loan demand. So they bought treasuries, created this massive wave of treasury purchases. And it, and this is the most stunning statistic for people that understand statistics. They'll get how completely statistically impossible this is. So I looked at the 20 cities in the Case-Shiller Home Price Index. The correlation of those 20 cities for 11 months in 2021 was 0.98. That is almost perfect correlation. That doesn't mean they all went up the same proportion. And then they moved together almost perfectly for 11 months. House prices went up 46% on that index in 18 months. The Fed claims they had nothing to do with the supply of housing. They created the affordability crisis. Full stop. I mean, there is no other plausible explanation for why house prices went up that much, that tightly correlated, other than the fact that the Fed drove the spread of mortgages to treasuries to all-time tights, brought private equity money into the housing market, and a huge refi boom and a huge just housing boom, right? So
Yeah,
when
and just on that, the reality is too, that's what happened here. And then like I lived in Costa Rica for a little while in 2015, just between stuff, like because we could. Lived in Estonia for a summer in 2018, wanted to get a sense of that part of the world, traveled all over the Baltics, did a bunch of things. And what was amazing to me is I remember a comment that G. Edward Griffin had made to me back in 2012 when we were in the car together driving to a studio. I had him on a show back then that we were doing with Rebecca Costa. And he had said, we've exported the inflation around the world. That's how we've kept it where we kept it here. And then in 2015 and in 2018, I was in different parts of the world that you would think would be more affordable, but on a kind of dollar for dollar basis, like the 2-bedroom, 2-bath condo was basically the same, right? Whether you were in like there was maybe 3 or 4 countries where you could still get a deal, but for the most part, this was true regardless of the currency you were in. And
right, this all began with the non-crisis QE era, right? So QE2, I argued back then that Friedman would have approved of QE during the crisis, but he would have never approved of non-crisis QE. So that whole process, it helped our real estate market clear, but it cleared with institutional buyers, not households. So it was the wrong way. But moving forward to the current environment, when the Fed decided to tighten, now there's 3 channels to asset purchases, right? There is the reserve channel where they buy those bonds, they deposit reserves in the banks and hope the banks lend the money. The second channel is the duration channel. When they buy duration securities, they lower long-term rates, which is the discount rate for making long-term capital investments. And at the household level, that means a house, right? At the corporate level, it's longer-term CapEx. I said earlier, CapEx was depressed in the 2000s because the Fed held that rate below where it would be otherwise. It didn't settle in at a natural Wixel sort of a level. And then there's the volatility channel. When they buy mortgage-backed securities, that mortgage prepayment risk is the biggest source of volatility in the markets. The Fed doesn't hedge it. They just reinvest in more securities. The MOVE index, right, the benchmark for vol, the median of that was 100 before the financial crisis. It's been 75 ever since. So they suppressed vol. Warsh mentioned that the other day. He mentioned volatility suppression, right? Well, that was in the context of forward guidance, but mortgage-backed securities purchases are insidious. When they unwound, the only channel that QT worked through was that reserve channel. They let the duration get longer and longer, didn't sell any mortgage-backed securities. And so those channels remained in place. So now you have the Fed's balance sheet providing 50 to 75 basis points of accommodation for long-term fixed rate borrowers like hyperscalers, who are also getting favorable tax policy from immediate expensing of equipment, their semi purchases, immediate expensing of factory investment, their data center, and they're paying a rate 50 to 75 basis points below where the market would set it. But so that applies sort of to big banks and high quality investment grade borrowers. But if you're a short term borrower, a household living paycheck to paycheck, a real estate mom and pop developer who borrows at a small bank, you're a small bank who depends upon the 3-month 10-year part of the curve being somewhere around 140 basis points. It's median since 1941, but it's 70, right? The credit channel's closed and the credit's not available. So the policy rate is 50 to 75 basis points too high. So that's why small business employment in the ADP report is contracting by 25 basis points a year, while businesses with over 500 employees is increasing by 150 basis points per year. That's the K-shaped economy. The Fed did it, right? It's like trading places. Remember? It was the Fed, right? That's
Right.
how the whole thing came down. And this is what Warsh and Besant want to fix. But Yellen and Powell left the two of them with the sword of Damocles hanging over their neck, issuance of bills at 33% of total issuance when the Treasury Borrowing Advisory Committee says it should be 15 to 20. So too much financing in the front end for Besant because 10s went to 5% in October 23 and Yellen panicked and started issuing more bills. And then Powell having this giant portfolio with a weighted average maturity of almost 9 years, when the committee said in October, we think this should be at the level of Treasury's outstanding, which is 5.4. And guys like Barr, who used to be the head of vice chair of supervision, saying, oh, we're getting there. Yeah, you know how they're getting there? They're reinvesting mortgage paydowns, $14.5 billion a month, into Treasury bills. It'll take 10 years to wind that Treasury portfolio down, and they still won't be at the level. They're going to have to change the reinvestment strategy and stop buying 24% of every 10 and 30-year auction. The Fed is still buying. Like, why would the Fed still be buying 30-year bonds?
Well,
This
and
is wrong.
that's
Let's
the other argument.
the
That's the other argument, right?
economy
Is who's
is a big
is
problem,
right? Is
right?
the
And
auction
I've
market,
been
is the auction market supply demand also broken in a way where we can't stop doing that? And, we could argue, well, maybe stables, maybe some of these other things that are going to create new demand and new requirements will help buffer it. But will they buffer it against the trade war drop off, whether it's Japan or whether it's China, unloading at a bigger rate? Can the Fed clean up its,
it
remaining
can
MBS in its treasury? And
it can
it sounds like we got the right people on the field, regardless of what maybe the mainstream media wants to say about being a tool for for the administration, whatever. I mean, at the end of the day, you need coordination one way or the other. You had coordination going this way. You kind of need that pendulum to come back. So at least if there's fiscal dominance, according to Lynn Allen, right? Lynn Allen, nothing stops this train. If that's the case, you still need monetary policy to kind of not fight you on trying to bring it back to some kind of
yeah.
equilibrium.
Here's what Besant and Warsh, Bowman, all want to do, and they can do it. We need this inflation, spike in headline inflation to pass. But here's how you get there. There's three elements to it. You need a steeper yield curve, so you need to cut that policy rate to 3, roughly. You want a bull steepener, not a bear steepener, right? So you need that policy rate cut. You can, at the same time, you offer regulatory relief to the banking system, right? So when you hear Fed officials talk about shrinking the Fed's footprint, they talk about the asset side of their balance sheet and the liability side. Right now, there's $3 trillion in bank reserves. There doesn't need to be that much, but part of the reason why there is that much is because of the rules that were put in place after the financial crisis to avoid a run on repo like occurred before. So things called the liquidity coverage ratio, net stable funding ratio, high quality liquid assets, all this stuff. Bowman has already said, the vice chair for supervision, she wants to cut these liquidity requirements fairly significantly. You could take that number down to probably something more like 2. The Fed also stops paying interest on reserves over and above what banks are required to hold. That stops the incentive to just keep the money on deposit at the Fed. So now all of a sudden you don't have all this money sloshing around the system. You have a steeper yield curve. The smaller banks, as defined by the Fed report, which is banks ranked number 26 and the rest in terms of assets, which is about 40% of total bank assets, barely their assets in treasuries and mortgages haven't changed since Silicon Valley Bank went under. That's because the curve isn't steep enough. There's no incentive for them to buy them. A steeper curve, you can sell plenty of 3 to 7 year treasuries to the banking system. As far as the back end goes, if you look at the right way to think about this total stock of government debt is not to compare it to GDP. GDP is a flow variable. It's to compare it to total household net worth. On that basis, we're in the middle of the post-World War II range, not at the high end of the range. So there's plenty of money at the household level to buy treasuries at the right price. The
Mhm.
difference is we're going from price insensitive buyers, first China and Japan during the conundrum, 2004 to 2006, and then central banks after the financial crisis, to actually placing it to price sensitive buyers. So you need that incentive. That incentive is the yield curve, right? So
Yeah, and that's
there's
where
the appetite for this, but you gotta go through this whole bank regulatory relief, cutting the policy rate, and unwinding the duration in an intelligent, not on autopilot. God help us, don't put it on autopilot again. But, tactically smart
so
would do things in a
it sounds like the dry powder is there, right? The money market, good accounts are somewhere around 7.5 trillion, right? So you've
that
got
money
seven
is not
and a
going
half
to flow
trillion,
into equities.
right?
It'll go into fixed income.
It's looking for a reason to buy. Is give me a price to buy at, and you have 7.5 trillion, which is a all time high that could move in some percentage to that
Right.
once you have enough of a yield curve for it to matter. So you that's the thesis there. The other piece I'm curious about is you mentioned repo when it was, when the run happened. There's been a lot of, volatility in the repo in the last 18 months, a lot of people writing about it. How do you think about that as it relates to just it's there, so I'm going to use it, and why take counterparty risk I don't have to, or is there something more signaling about that you pay attention to?
There's too much incentives for banks to hold money in the front end of the curve, which probably goes as far as lending money to triple leveraged ETFs to be able to make overnight loans. There's just too much money in the front end. The attention on repo is there's just way too much focus on that. There's a couple members of the Fed that are obsessed with it because that's what they've spent their whole career doing. One is Lori Logan at the Dallas Fed, who used to be in charge of the markets group at the New York Fed. She that was her job, right? She implemented that. Beth Hammack, the Cleveland Fed, was on the money markets desk at Goldman Sachs. Now, I'm going to say something that's going to sound a little pejorative. Um, I thought I was going to spend my whole career at Lehman Brothers. You got to think back about what the two guys that were running the firm, how they made their career. They came out of the commercial paper business at Lehman Brothers before the Shearson merger and all. You don't want the guys on the repo desk running your business. They're like, we used to laugh about it and say that the repo guys would crawl across class naked for 4 basis points, right? So like, you know, treasury traders, mortgage traders, equity guys, like you have to focus on these broader, more secular themes, productivity and the like. The repo guys, and like, when presumably Logan and Hammack talked the Fed into ending QT and then doing the reserve management purchases that look like they've contributed to all this speculation because money leaks out the side. There was a framework that had been set down by Roberto Perli, who's head of the markets group, has Logan's old job at the New York Fed for, hey, this level of volatility in repo markets and spreads, and we'll need to end QT. They hadn't hit any of the benchmarks. Repo market wasn't that volatile, wasn't that big a deal. Those of us in the markets were looking at it going, yeah, it's moving around a little bit on quarter end and stuff. That's just bank regulatory nonsense. It's a non-story. Somehow the Fed's like, nope, got to stop QT. Nope, we got to buy 40 million bills a month, pour more money into the front end, and hope that That just makes us doing our job easier. Well, what about all that money in the front end that appeared during Y2K? What about all that money sloshing around in 2021 and the meme stock craze and upside calls being more expensive than downside puts in tech stocks? The same thing happening now, vol up, price up. You didn't think any of this money's leaking out the sides? It's insane. So there's no issues in the plumbing of the financial system. They've gone way too far. It was a giant overreaction to what happened. And by the way, none of this needed to happen. The reason that Lehman went down was purely political. We had sufficient liquidity for 9 months. You can, if you don't believe me, read The Fed and Lehman Brothers by Lawrence Ball, the Hopkins professor, who goes through all this. And I can tell you from experience, speaking to the guys that were there that day, when the Fed opened up the range of collateral to the primary dealer credit facility, PDCF, our guys were cheering. We're saved. And then Paulson overrode Bernanke and said, nope, this applies to everyone but Lehman. I got excoriated in the press for Bear Stearns. No deal for Lehman. Bear Stearns asked for the same deal to take our commercial real estate assets. Paulson said no. And that's why the whole run on repo occurred. That's what the Fed was originally, enacted to do, was to be Walter Bagehot, lend generously at a punitive rate when there's a crisis. That's what the Fed was supposed to do, and they failed to do it in September of 2008. So they overreacted. We don't need all this money in the front end. We actually need the money out of the front end to go into this manufacturing renaissance that I'm so convinced is going to occur, and we'll get to a much better place. Warsh knows it. Bessent knows it. That's Bessent's Main Street versus Wall Street theme. And so back to your original question, there's parts of the economy that are really struggling, and you can see it in wage growth. Like, this morning's numbers are fascinating. The strongest employment growth is in healthcare at about 2.4% annualized growth, but their wage growth is 1.25%. So you're hiring people into low wage jobs. The tech sector has 7% wage growth and negative 3% employment growth. There's AI in a nutshell, right? So they're getting more productive. They're firing people, but paying people a lot who are staying. And the only jobs that are being created are in low paying, low skilled jobs.
Yeah, and I think, so
There's your unbalanced economy.
yeah, so I'm curious, and I think I'm gonna invent this with you on the air right now because I've never heard of this before, and it's a really ugly looking W. But if you take your K-shaped thesis, right, which I that's what I see. I don't see anything but a K right now, right?
Right.
And that down leg of the K is not looking pretty if we don't kind of continue to move in the right direction. But let's say we could bend that downward K like really badly back into one of these, right? It becomes an ugly W where, the asset owners already had their rip, that keeps going. Now we kind of bend this thing back and it's like a really ugly W, call it a win. What does it take to get us there? What are our chances of getting there in the next 5 years? And what drives it from your lens? Because we have also this macro demographic shift, that's happening.
Right.
We have a temporary, I don't think it's permanent, but we have this like lack of new births, thing, but that's historically happened before. This isn't the first time we've seen declining birth rates, right? And usually these cycles. But talk to me about that. Let's talk about how we turn it into a W from a K.
Well, part of it is the rebalancing of monetary policy. It's easing the policy rate on the front end so that financing rates come down. We can solve part of the housing problem by making financing rates for small mom and pop builders that my old colleague, Steve Kim, who's now Evercore ISI's housing analyst, gave me a benchmark a long time ago. I think it's still the case that some 70% of residential housing construction is mom and pop builders. They finance at a local bank. The short-term policy rate is their policy rate. Cut that rate at least 0.5%. It starts to smooth the way towards solving some of the housing issues. That is a big multiplier on the economy. So that's part of the story for sure. Um, we're already seeing some of the headwinds from what I've been calling the four adverse aggregate demand shocks start to dissipate. And those demand shocks were what Treasury Secretary Bessent called our detox to our addiction to government spending. This pertains to one of your earlier questions or statements as well, which is government spending growth in the last year of the Biden administration was 11%. It's now 3, right? So 6 is the long-term median. It needs to grow slower than nominal GDP in order to stabilize government debt and for us to be able to finance the government, right? So, but that slowed spending, no question about it. If you look at the first quarter GDP numbers, consumption, including services, grew at only a half of 1%. It was 3.3 when Trump took office. Primary or private domestic final purchases, core domestic demand, less inventories and trade, was 3%. In the first quarter, it was 1.7. That's already reaccelerated in the second quarter. So the government spending shock, the layoffs in the government sector, that's starting to level out. It's not like we're spending more money anymore, but that first shock portion of that we've worked through. Immigration, which we had the biggest surge in immigration, population adjusted ever, including like 1890, that shock played a role in slowing demand as well, starting to stabilize. Tariffs, we went from a 2.5% effective tariff rate all the way up to 13. It was 8. The last month in May was actually 0 because the refunds started to kick in. So that's not going to the household sector, but it will put downward pressure on prices because there's about 170 billion of those coming. We'll see where trade policy goes. I don't believe we're going back to a 2.5% effective tariff rate. I think one way or another we'll wind up at 8 or so. But that hit is starting to fade. And then, of course, the energy price shock. So in the near term, I think consumption will likely pick up a little bit. Things will get a little better for the bottom part of the K. But I do think this cycle is likely to be more about CapEx than consumption. You do have a little bit of a demographic tailwind in the sense that if you've looked at, I'm sure you have looked at life cycle consumption, right? So for the period all the way up until about the pandemic, the second biggest age cohort, the boomers, were in peak savings mode because they were getting to retirement age. Mm-hmm. Well, they're now in retirement. So their marginal propensity to consume goes up a bit, right? Because you're now
primarily because of healthcare. Yeah, primarily because of healthcare and those.
Well, healthcare is a problem, and it's soaking up a large piece of it for sure. Right. I don't want to overcomplicate the story, but the second biggest the smallest cohort is Gen Xers. That's the cohort, right? I'm actually a boomer, 64.
Yeah, you're a good looking boomer. Oh, you're right on the cusp.
I'm right on the cusp.
Yeah.
1962, I was born. 64 is anyway.
You could be an OG Xer. You could be an OG Xer and a boomer, a neophyte boomer, right? Like you could be,
exactly. Yeah. And anyway, the Xers are in peak savings mode, but that's the smallest cohort. The biggest cohort are millennials, and they're in peak spending age. So you'd think on balance, that would actually increase our trend rate of consumption marginally. But we have these problems to sort out first: the imbalanced policy, the housing affordability crisis, the supply of housing. Like there's lots of stuff there that is a headwind to that millennial cohort. And so it's not entirely clear to me, how we completely resolve that K piece. Part of it is just, it's going to take time. Like the housing problem that the Fed created, that Powell, gaslighted us about by saying Fed policy has nothing to do with the supply of housing. You had everything to do with the supply of housing because you went so far overboard in 2021 that you created the crisis, right? So getting out of that, there's no easy way to get out of it. Like when President Trump gets asked about it, he goes, I don't want house prices to go down. People get destroyed, right? Like you can't. They just have to kind of go sideways for a time, and we need more support.
Yeah, I think that's the interesting. I've been thinking about that a lot, just in my own sense of like just looking at the personal side and trying to figure out what I want to do or don't do and why I would do it. The reality is like they need to go sideways for a little while, or they just, because the argument of, oh, they go 25-30% down. I mean, I guess you could find a steel man and make that argument and put some data against it. But
Not not without
when you
leverage.
think about the blast radius effects of that compounded with the other things you already mentioned, right? Like the jobs that are being created in non-tech are basically paying lower wages. And then the what like you just exacerbate that K if that was to happen. So whether it should happen or not, it's not the point. If you let it happen, or it's just gonna exacerbate the gap. And so I think sideways is the way. And if you think about prior to the Fed's interventions, like you mentioned, and I'm in your camp with that, I think they created the housing problem. I don't think it was a supply issue. If you look in up till that point, people didn't buy a house in the 70s, 80s, or 90s to get rich. And from 1999 early, definitely 2000 to 2006, they were buying it to get rich. Period. Full stop. There was no
I
reason
I
to.
I would tell my wife in the 2000s, when the housing market exploded and we lived in New Jersey and commuted into New York, there were certain couples that I would not go out to dinner with because that's all they talked about was the housing market or their kids. And I'm like, I don't really care about either. If you're not going to talk about sports or, something else. And even sports was a fraught topic because I was president of the Westfield Soccer Association, like the second biggest political thing in town. I wouldn't even go out to dinner with people because I didn't care about houses. I didn't, anyway.
Yeah.
But absolutely, listen, we the probability of having a big house price drop is so low because there's not the leverage in the system. There's not the leverage at the
Do
household
you
sector.
do you
It
think
just needs
though?
to bleed sideways, but you need supply. This is why I heard my old colleague and former Fed candidate Rick Reeder talking about it on Bloomberg this morning, and Rick's saying, hey, rates come down. That's actually going to reduce housing inflation. That's going to create more supply. And that's what people miss. And every time I'm on CNBC talking about it or Bloomberg, they always say, like, hey, if you do what you think we should do with the Fed's balance sheet, it's going to push mortgage rates up. I'm like, not if you lower the policy rate. The mortgage rate doesn't move all that much. And by the way, the primary secondary spread between mortgages uh, that you pay, the mortgage rate you pay, and what Fannie and Freddie paper trades at has gone up. It's doubled basically because they basically pushed all the mortgage lending out of the banking system, which Bowman's going to correct. And so the only place to go is Quicken to get a mortgage now. And they don't hold any mortgages. They
Right.
just securitize it. And so that spread's gone from like 70 basis points to 130. And that could be lower too. So there's ways to lower the mortgage rate to get it at a more affordable level. But the key is to get the construction going. And to get the construction going, that means lowering the short term policy rate so that builders have cheaper finance to go out and build.
Well, and you also have to do some things to create the resale market being a, an on par option with new development, right? Because in places
100%.
like where I live, there's not a lot of new constructions for any number of reasons. And even if you did, you wouldn't be able to get up to speed with the demand of people that want to maybe buy a house versus rent. And so when a resale is there, they can't buy down the rates, which is what the builders have been doing, whether they're corporates or small. They've been able to buy down the rate to get you in the home because it's all part of the math. They can figure it out somewhere else. So yes, you free that up if you make it easier for the local builder or the regional builder. I agree with that. I think the other thing you have to do with that policy number coming back down to somewhere in that 3 range is you make it possible for the resale market to have a chance to be competitive with new development because some people want an existing home or they like the neighborhood and there's no new development in that neighborhood.
100%. I mean, where we lived in New Jersey for 30 years, lovely town, Westfield, um, taxes are prohibitive. But if you're working in New York City and you've got family around, it's a great place to live. But there's nowhere to build. I mean, that town was incorporated a long time ago, and you could do a tear down, but there's no new construction.
Right.
Out here, there can be some construction, but there's not a lot of land in Vail either. So I totally
Right.
get that point.
Yeah.
But what you can do as a policymaker is rebalance policy, and that's
So do you as we kind of wind up this, I mean, what are the topics that we didn't touch on yet that you think we should? I'll give you a chance to kind of take us in a direction. Maybe there's something that you are writing about at present that's kind of top of mind that you think everybody should be paying attention to. If
well.
so,
Let me weave how I've expressed this K-shaped economy, those adverse aggregate demand shocks, the capex boom, into my equity and asset allocation over the course of this year, last couple of years. So, in particular, really since I got this idea in February of 2025 that we were going to have, I didn't call it a detox, I called it cleaning up the industrial policy mess, all the spending the Biden administration was doing. And then 3 days later, Bessent went on CNBC, the same show as me, and called it detox. And I like that better. But anyway, I've been underweight consumer facing sectors. So I've been underweight the discretionary sector, the staples sector, and the healthcare sector. Um, Healthcare sector's got its own idiosyncratic issues. I'm all in on making America healthier again. I live in Vail. You can imagine how focused we are on that. But I've been underweight those sectors and overweight capex related sectors, and not just tech. I'm actually underweight, as I mentioned earlier, but overweight industrials, overweight financials, overweight materials, overweight energy, with this idea that we're going to have this sustainable capex boom that's going to transcend just AI and will last through the whole of the business cycle. And that's been the core theme of my sector allocation, and continues to be. We've made some tweaks around it, and we do make some tactical changes here and there, but that's been a core theme. Now, we've kind of hit, as I mentioned earlier, a little bit of a cyclical peak within the secular trend. I think the detox bottomed out in the first quarter. Some of those headwinds are fading, so you'll have a little better performance. I express that by adding a mid-cap position rather than going into discretionary or staples, because I still think they have some issues, but that's how we've been expressing those broad themes within the equity market. Within asset allocation, I can't bring myself to be at 40% against the 60-40 benchmark fixed income, because the Fed's portfolio is still holding long-term rates, the term premium or premium you should receive for taking maturity risk, interest rate risk, it's still too low, right? It's about half of where it should be, 50 to 70 basis points below its longer term median. So I'm still underweight fixed income, not wildly underweight. I think right now I'm at about 67.33, but still underweight fixed income somewhat. It does make it tricky because, by most accounts, the equity market's expensive, but it's really not expensive on an equal weight basis. There, we're almost at the median. It's expensive on a cap weighted basis. So for people that are preserving capital, thinking about things a little bit longer term within these trends I've talked about, you might prefer the cap weighted indices or cap weighted ETFs over the equal weighted ETFs over the cap weighted ETFs. You might still underperform a little bit. Although so far this year, that equal weight index is actually up more than the cap weighted index. That's probably a better way to think about how you're.
yeah, that's a point. I think that's a practical point there, which is understanding your horizon of time is always important, right? And so if where you're at is you want to beat the hurdle rate, you want your future self to be richer than your current self, but you're most focused on not losing or preserving that purchasing power or that utility of wealth. Then on a relative basis, the metric changes from, oh, are we at too high of a PE on these stocks? Is it a bubble? It changes that, and that becomes noise, and the signal becomes, am I equal weighted to something that might be more in a sustainable range? And if so, that's the ETF that I allocate into. And
If I'm right and we're nowhere near the end of the business cycle because we don't have the imbalances in the private sector, right? We don't have high non-financial corporate sector debt. We don't have high household debt. Business cycle is unlikely to end as Tyler Goodspeed wrote in his recent book, which I think is a pretty good read for anyone who's really interested in economics, called Recession, quoted Bernanke early on by saying business cycles, expansions don't die of old age, they get murdered, right? And so he contends they get murdered by policy issues, wars, energy shocks. Some of them are exogenous, some of them are created by the policymakers themselves. But other than some massive policy mistake, and we're already dealing with one, which is this whole Fed imbalanced policy and K-shaped economy, but Warsh has every intention of resolving that, as does Besant. I don't see the business cycle ending. So, if you buy the equal weighted S&P at 16 times earnings, you're buying it pretty close to the median long-term level of valuation. And if I'm right, you're going to have this broader CapEx cycle. CapEx is a boost to earnings more so than a consumption-driven economy. You probably have a pretty good, you could have a pretty good cycle. The CapEx piece has worked because Mike Green's going to tell you, because of the whole money flow indexation stuff, that he makes me feel guilty for ever having anything to do with. But, but if you set Mike's argument aside a little bit, and I wouldn't totally set it aside, there was a view that these big, Mag 7, big spenders had some giant moat around them. Do they really? Like, is Google's Gemini product that much better than Anthropic's product? Is there really a moat? It's not so clear. I mean, yeah, Meta's got a little bit of a lock on the social media universe, but it's just a social media universe, right? Like, there's lots of other things going on in the economy. And so I really wouldn't be afraid of being long equities if you're in that equal weighted part of the markets from a broader, building your wealth in a methodical kind of way perspective. I don't see signs of business cycles about to crack. So with that in mind, and a CapEx cycle that's likely to drive stronger earnings growth over time, this could be an okay cycle.
Is there something that you have on your radar as the murder equivalent, whether it's, Iran kind of going the wrong direction or flaring up now? Is it like just continued
government debt?
Government debt. Okay.
Government debt, losing control of what Warsh investments want to do. And so, listen, when you look at government spending and receipts over time, receipts have averaged 17.1% of GDP since World War II. That's all tax receipts, tariffs, customs duty, whatever. 17.1, subject to an 80 basis point standard deviation by administration. So think of it this way. Democrat comes in, raises taxes to solve our budget problem. Receipts go up for a year, they go back to 17.1. People find a way to not pay it. Republicans come in, tax cuts are going to solve all our problems. Receipts go down for a year, they go back to 17.1. You can argue about which one drives stronger growth. I have my biases. You can guess what they are.
Right.
That notwithstanding, spending averaged 17.6 from World War II through 1981, but then went to 20.3. But even at 20.3, the primary deficit was zero. Primary deficit is interest pay, or basically removing interest payments from expenditures. So we had a balanced primary balance. Debt didn't increase at all. It had fallen from over 100% down to 34. It was pretty much stable until the global financial crisis, when we monetized a bunch of debt, and then the pandemic, when it just exploded. Now, the Biden administration put government spending on a track for 25% of GDP. It's at 23 right now. Government spending growth slowed from 11% in the last year of the Biden administration to 3. It was at 2 from 2011 through 2018 after the Budget Control Act of 2011, when we had the whole sovereign debt crisis shut down, but then they cut a deal, right? And that's part of the reason why we didn't have any inflation in the 2000s, because inflation is always and everywhere mostly a fiscal, but also monetary phenomenon, right? It's periods when we have strong fiscal spending that drive inflation. And I could talk through the 60s, but we got to wrap this up. And anyway, that Budget Control Act 2% spending growth cap was busted in 2018 when the Republicans lost the House and the Trump administration had no choice but to cut a deal with Schumer and Pelosi to bust a cap and raise government spending growth back up to 6. Republicans lose the House this fall. We're going to hit the debt ceiling and we're going to find ourselves in the same position. So right now, the best indicator I use for is the supply of treasuries overwhelming the market's ability to absorb it is swap spreads. That's the spread between an interest rate swap and the underlying treasury security in the 10 and 30-year part of the curve. Those got really negative in the last couple of years of the Biden administration. They recovered when Bessent was named Treasury Secretary. They plunged after Liberation Day, but then they've been grinding tighter ever since because government spending growth has slowed. If it goes back up to 6, back to nominal GDP next year, then you might start to see the market struggle with this. And
so your core thesis is the business cycle.
The whole plan that Bessent and Warsh have, it's really complex to get out of the mess that Yellen and Powell left for Bessent and Warsh. And if we accelerate the growth rate of government spending next year, that will make their job that much more tough. So it's not a this year problem. It's a 2027 problem. But it is, for me, someone that thinks a lot about debt markets, that's like the big existential issue.
So how from a practical takeaway, what you're saying is, as of right now, you see the business cycle as strong and not being disrupted, except for potentially a policy mistake that could murder this business cycle from its normal course of direction. You just named what you think that murder weapon would be, right? Which would be the government debt kind of in a spending increase being triggered in the fall. That could happen through any number of things in the House or in the Senate that go the wrong way or whatever that may be. But how do you hedge against that? What is your recommendation, or what are you writing about as it relates to that? That it kind of says you don't need to worry about that now, but if you were worried about it and you wanted to kind of put your own opinion to feel like you had your hands around it, if it comes in 2027, here's what I'm thinking.
Well, if you ask Treasury Secretary Bessent directly about this, his response would be, obviously he knows all about this and he's spoken a lot about it, but part of the way out of this and the whole story in terms of how we wound down the World War II debt, and it's complicated because that was World War II debt. It wasn't driven by mandatory spending, Social Security, Medicare, Medicaid. But part of the other way out of it was we had a productivity boom from the end of World War II through the early 70s. So if we are going to have a productivity boom now, and there's lots of signs that we are, that could increase the non-inflationary growth rate, nominal growth, and there is an element of being able to grow your way out of the debt, kind of like the housing market, right? If we can somehow just keep that spending from going faster than nominal GDP, then it won't grow. And so, the hopeful side of all this and the way I'm positioned for it is I'm long all those sectors that would be the engines of productivity growth, that would drive productivity growth. But there's a little bit of inflationary impulse there too, because companies with high fixed costs, like energy companies, materials, industrials, would benefit from slightly higher trend inflation. And this whole CapEx build out, stronger nominal GDP. As to how I would hedge against it structurally, I'm somewhat underweight fixed income and somewhat underweight government securities because this is such a complicated problem. I don't think you can just, as a pension fund might do, decide, okay, I'm overfunded. I'm just going to immunize my way out of this, buy a whole bunch of 30-year, securities and just like drink 3 martini lunches and not worry about it. Because if inflation does end up running faster because government spending growth accelerates, then you won't be immunized, right? I mean, that's the negative surprise that would kill you. So I do think inflation will run faster than it did in the 2010s. I don't see it as running too fast, but government spending is the key. And
Well,
one anecdote about that, just to make the point, is in 1964, when we passed food stamps and then later Medicare, Medicaid, we had 450,000 people on some form of social assistance in this country. By 1975, we had 15 million.
wow.
Direct transfer payments as a percent of GDP went from under 6% to 13.5% over that same interval. That's what caused the great inflation, not the Fed.
Well, and if you
Not,
look at those numbers today, they're pretty scary. I mean, just in the state of California, those numbers are pretty bad in the wrong direction.
I understand.
So
We're at 18.6% right now.
that's federal, that's global, or I mean,
Direct transfer payments as a percent of disposable income. And if you look at that chart over time, and it's something I publish periodically, you see periods when it started to contract as disinflationary periods, like during the 80s and 90s, and then periods when it accelerated and it exploded to like 30 during the pandemic. And I mean, it's little wonder goods price inflation went from 0 to 12.5% in a year when we sent out $500 billion worth of checks from March 2021. Goods prices just exploded.
oh, the 4th of July tri-tip went from $27 to $58 this year. So, there's that. It's going to taste extra good this year. I hope.
Anyway,
Hey,
so
Barry,
it's been an
absolute pleasure.
That's the big overarching macro risk. So
Yeah, it's been an absolute treasure and pleasure. I was going to say treat and pleasure, and I said treasure. So there's a new one. Anyway, it's been awesome having you. Thanks so much for giving us, almost 2 hours of your time today. For all those who tuned in, same thank you for the attention deposit you made. I think you now understand why you can trust Barry a little bit more to give you stuff to think about. And if you're not currently subscribed to him, I'm encouraging you before you hang up to hit that button and do it. Pick what level is right for you. But that's my unsolicited plug, because I know I'm glad to be reading and following this man on Substack and everywhere else. Check him out. So please make sure you do that. The replay, if you're listening to that, you're also reading the article. So I encourage you to kind of unpack the article and look for the sources in there that can help you understand a lot of the things that he's been talking about, because he covered a lot of ground. So for the masterclass that was Barry C. Knapp on the atomic level, I'm signing off and I'm saying thank you on behalf of everybody.
thank you.